bankruptcy.
A stunning fall.
Major restructuring.
Debt is piling up. Companies are filing for bankruptcy now at the fastest rate since 2020.
The U.S. economy is entering a dangerous moment, and the warning signs are everywhere. Mass bankruptcies are spreading across major industries, and the companies collapsing are anything but small. First Brands Group, one of the country's largest auto parts suppliers, has fallen into bankruptcy with up to $50 billion in liabilities and more than $2 billion in missing funds. PrimaLend, a major subprime auto lender, has also gone under as borrowers default in record numbers. These are companies that survived the 2008 crisis, but they can't survive the pressure of 2025. Workers are losing income. Families are losing stability. Entire regions are losing economic strength faster than most Americans realize. Then the warning lights got even brighter. Janet Yellen, former U.S. Treasury Secretary, publicly criticized the chaos created by Trump's decisions. Her message was blunt. Investors are losing trust, research funding is shrinking, and America's long-term strength is being damaged. When a former Treasury Secretary speaks like this, it means the danger is real. And while all of this unfolds, China is quietly buying massive amounts of gold. Beijing is moving in silence, but the numbers are huge. And the shift affects global reserves, the strength of the dollar, and America's financial future. If China keeps accelerating, the pressure inside the U.S. economy will grow in ways most citizens aren't prepared for. Before we break down the facts, make sure you're subscribed. What comes next will reveal every piece of this crisis. Let's begin. Look at what is happening to corporate America right now. Large company bankruptcies hit 655 filings through October 2025, the highest level in 15 years. That is more than double the pace of 2022 and nearly equal to all of last year. The industrial sector is taking the biggest hit, with almost 100 major industrial firms going under. Consumer-facing companies are also collapsing in large numbers. These aren't small, isolated failures. These are big businesses shutting down, and the pace keeps accelerating. A major driver is Trump's tariff strategy. By raising import duties on industrial goods, including critical auto parts, manufacturing costs jumped overnight. First Brands Group, one of the country's largest auto parts suppliers, said exactly that in its bankruptcy filing. The company blamed Trump's tariffs for squeezing margins and making its operation unprofitable. First Brands is now pursuing a $500 million debt settlement because it simply could not absorb the extra costs while carrying a huge debt load from earlier acquisitions. That is not just bad management. That is the direct impact of policy. When costs spike like this, struggling companies borrow more to survive. But the debt becomes a trap. First Brands disclosed over $11 billion in liabilities and now faces investigations into more than $2 billion in missing or questionable funds. Creditors suspect some invoices were pledged more than once to raise cash, a sign of a company pushed past the breaking point. Heavy debt combined with tariff-inflated costs created the perfect setup for collapse. But the damage isn't limited to manufacturers. Trump's policies also pumped risky credit into the auto market. PrimaLend, a major subprime auto lender, just filed for Chapter 11. Inflation, high interest rates, and volatile used car prices made it nearly impossible for low-income borrowers to repay. The company expanded rapidly under looser rules and political encouragement of financial inclusion, but that growth has now reversed into a full-scale implosion. And then there's Tricolor Holdings, another subprime lender that entered Chapter 7 liquidation in September 2025. The company catered to poor credit buyers, but it collapsed under fraud allegations, including claims it reused the same loan collateral to secure multiple credit lines. That is not a one-off scandal. That is systemic weakness inside the subprime sector. Add it all together, and the picture is clear. Trump's trade and financial policies did not strengthen corporate America. They hollowed it out. Tariffs drove up costs. Risky lenders flooded the market with fragile credit. Now, multiple major firms are collapsing under the weight of those decisions. This is not a random credit crunch. This is the predictable result of policy choices. When companies of this size fail, jobs disappear, tax revenues shrink, and supply chains break apart. The public data shows the same pattern everywhere: higher costs, tariff shocks, and more expensive borrowing for non-tech companies. The bankruptcies cluster in the sectors hit hardest: industrials, consumer discretionary, and even household staples. According to S&P Global, June alone saw a record 63 large company bankruptcies, and that trend kept rolling all the way into November. If businesses keep falling at this pace, what will employment look like 12 months from now? And while these companies fight for survival, something even bigger is unfolding in the background. A capital shift so large that it is reshaping the entire financial landscape. The United States has been pulled into an AI spending race, and the money flowing into that race is leaving the rest of the economy exposed. AI infrastructure could cost up to $5 trillion, and that money has to come from somewhere. Major financial institutions warn that bond markets will carry a huge share of the burden. JP Morgan projects global bond issuance tied to AI will hit record levels in 2026, with about $1.8 trillion in new debt as companies and governments rush to build data centers, buy GPUs, and secure massive amounts of energy. Other analyses show hyperscalers will need hundreds of billions more in the coming years. When that much borrowing hits markets at once, the price of credit shifts. Capital markets are not infinite. When AI giants issue wave after wave of investment-grade bonds, yields rise and investors prioritize them. Smaller companies, industrial firms, retailers, transport companies get pushed aside. They face higher borrowing costs or no access to capital at all, while AI firms absorb an enormous share of available loans. Analysts note that hyperscalers reinvest most of their cash and still issue large amounts of debt. That forces every other company to borrow at higher rates. Non-tech firms are already paying yields far above what they saw 2 years ago. Those higher costs are pushing weaker businesses into distress and feeding the bankruptcy wave we covered earlier. This is why so many companies are failing at once. Tariffs raise costs on one side, AI borrowing drains capital on the other. Companies caught in the middle are being crushed. If AI companies keep borrowing at this scale, which industries will be forced to stop investing next year? The U.S. Treasury is selling bonds at levels that directly affect your mortgage rate, your local factory, and the cost of every major project in the country. Washington faces huge rollovers and new borrowing needs at the same time, creating a heavy calendar of redemptions and fresh issuance. To keep near-term costs down, the Treasury has shifted more borrowing into very short-term bills because those yields are cheaper than long-term notes. It works for now, but only for now. Short-term debt must be refinanced constantly, and if rates rise later, the government feels the pain immediately. Long-term risk is still priced through the 10-year yield, which has stayed above 4%, showing investors remain uneasy about inflation and future demand. Here's where the pressure accelerates. Flooding the market with short-term debt saves money today but increases future strain. And because big tech and AI giants are absorbing so much of the bond market's demand, the Treasury faces tougher competition for buyers. If AI borrowing keeps expanding, the government will need to offer even higher yields to attract investors. The 10-year yield is already rising. That means higher mortgage rates, more expensive corporate loans, and an even harsher environment for local businesses seeking capital. Washington's workaround slows the pressure. It doesn't solve it. Too many borrowers are chasing the same pool of dollars. How long can the government rely on short-term tricks before those tricks turn dangerous? The job reports make the picture impossible to ignore. Official BLS data and multiple independent analyses show that U.S. manufacturing has lost tens of thousands of positions since April 2025. One detailed study estimates a drop of roughly 42,000 manufacturing jobs following this year's tariff actions. The BLS employment series also shows declines in key sectors like transportation equipment and semiconductors. These losses are not random. They are the direct result of higher input costs and rising financial pressure flowing straight into factory payrolls. But this is bigger than jobs alone. It's about the country's production base and whether advanced manufacturing stays onshore at all. When companies face higher import prices because of tariffs and higher borrowing costs because capital is being pulled toward AI and government debt, investment decisions change. Expansions are delayed. Equipment upgrades are canceled. Some companies simply move production to cheaper regions. Other countries see the opportunity. They are using state-backed financing, cheaper credit, and logistical incentives to expand their own capacity, while U.S. plants slow down or shut their doors. Public data on production, trade, and employment all point to the same reality. The decline is already underway, and foreign manufacturing centers are gaining ground. And once investment leaves a region, it rarely comes back. Supply chains shift. Worker skills erode. Local factories that close during downturns often stay closed permanently. If your community depends on manufacturing, how long before the options around you shrink even further? Credible voices are now confirming what the data has already been showing. One of them is Janet Yellen, the former Treasury Secretary. She has publicly warned that recent policy decisions are creating real risks for America's long-term strength. Instead of focusing on markets alone, she pointed to something deeper: the weakening foundations of U.S. research and innovation. Yellen highlighted that tariffs, unpredictable trade moves, and proposed cuts to federal research budgets could drive academic talent away from American universities. Her remarks focus on two clear dangers: shrinking funding for universities and growing hesitation among global investors, watching Washington's choices. These aren't abstract concerns. They have immediate consequences for federal labs, tech development, and the country's ability to stay competitive. Think about what this means over the next decade. When research grants shrink and universities lose staff, the flow of innovation slows. Companies that rely on university partnerships will struggle to recruit PhD talent. Some projects will move abroad to places offering more stable support. Early signs of foreign recruiting efforts aimed at U.S. scientists are already appearing in academic and industry reports. The outcome is predictable and measurable: slower innovation at home, faster progress overseas, and a gradual weakening of America's position in critical science and technology. If top researchers begin accepting long-term roles in other countries, where will the next breakthroughs come from? Watch what China does even when it says nothing. Multiple reports indicate that Beijing is quietly buying large amounts of gold. Analysts at major banks, using trade and shipment data, estimate China's total gold purchases in 2025 may be far higher than official figures, possibly reaching around 250 tons this year. Some sources even suggest China is buying up to 10 times more than it reports publicly. That would place China among the largest central bank buyers in the world. Much of that gold appears to be coming from UK and Swiss vaults, where major market clearing takes place. Analysts say Beijing hides the scale of these purchases to avoid pushing prices higher while it accumulates. At the same time, global reserve behavior is shifting. World Gold Council data and market analyses show a sharp rise in the share of reserves held as gold. Several reputable summaries note that in 2025, gold's share in central bank reserves rose so much that, in some measures, it even surpassed treasuries for the first time in decades. That is not symbolic. It is a direct response to geopolitical risk and policy uncertainty. And this is where timing matters. China is reducing exposure to U.S. debt ahead of the heavy refinancing cycle coming in 2026, when Treasury issuance is expected to surge. By buying gold and trimming its Treasury holdings, Beijing is insulating itself from future U.S. financial pressure and quietly weakening demand for the dollar. Why would a major economy shift into gold so quickly and quietly? And how does that reshape global reserves? Put all the pieces together and the outcome becomes clear. Heavy tariffs, rising uncertainty for businesses, and the massive shift of capital into a single technology sector have created a chain reaction across the economy. The result is visible everywhere: a surge in large company bankruptcies, sharp losses in manufacturing jobs, higher borrowing costs for any firm outside tech, and foreign central banks quietly changing their reserve strategies. Credible reporting connects each of these outcomes directly to policy choices and to the way markets are reacting to them. Analysts inside and outside government are saying the same thing. Current policy is reshaping market behavior, and the direction is not toward stability. This is the moment when long-term trends stop being theoretical and start becoming structural. If America's financial foundations keep cracking at this pace, what event finally forces the world to stop trusting the dollar? Share your thoughts in the comments, and make sure to subscribe. See you in the next one.